everyone. Good evening. This is on June 14th. We're doing a recording of our Charts Are Fun weekly session. This is for the week of June 10th. A lot has happened in the market. Today's agenda, we will dive straight into what happened in the macroeconomics. We had CPI and PPI. CPI came out on Wednesday, and then PPI the day following on Thursday. FOMC, of course, met this week as well. So this was on Tuesday and Wednesday. All three are pretty market moving. And then on the earnings front, and more than that, started off the AI, call it the AI euphoria. A lot of key stocks have moved this week on AI, starting off with Apple. Apple had a huge movement this week with their Worldwide Developer Conference, where they launched their AI intelligence, partnering with OpenAI. And then earnings came one after the other, all touting and strongly benefiting from AI. So you had Apple, like WWDC. NVIDIA, of course, keeps climbing. There's absolutely no loss of momentum to that. Keeps climbing literally every day. We'll talk about that. But in terms of core earnings, we had Oracle. Oracle just absolutely announced like 30 new customers on their double-digit cloud growth on AI, with OpenAI now being their customer as well. We had Broadcom announced a 10:1 stock split, but like almost 25% of their revenue growth comes out of AI, heavily touting that. And then to top it off, Adobe, the largest, call it the video publishing software maker. A lot of the creative folks use Adobe. They had an outstanding quarter as well, strong, almost 2 billion out of the 5.2 or 5.3 billion revenue for the quarter. 2 billion cash flow. A lot of that they attributed to AI-enabled efficiencies. Of course, we're not going to not touch on GameStop. It's an absolutely a story stock, has been a meme stock, but tremendously moving around this week. Roaring Kitty announced his new positions, converted his options to his shares now. So we're going to talk about that. I think he owns over 9 million shares now in the stock, and he's probably the third or the fourth largest shareholder after the founder himself and a couple of other Wall Street firms like BlackRock and one other firm. And then the blog that I talked about today was about the energy and the energy sector spider XLE. So I'm going to touch about that as well. So with that, let me share my screen and go straight into the charts and the core topics for today. So this is our blog site. It's in, before I go to the blog site, let's talk about our YouTube site, Charts Are Fun. That's the channel, @Charts Are Fun. We hugely encourage you to subscribe to the channel. It's free, of course. And if you like the videos, if you could hit the like button, helps us share our videos with a broader audience. We tend to post videos every week, like we're posting it this week. This is for the week of June 10th. Today we're recording it on Friday after the market close, of course, on June 14th. And we also publish daily blogs. And in this week in particular, we published 5 blogs Monday through Friday. The blogs tend to come out in the morning. If you could subscribe to this, it's on Substack. Just put your email, it's free. You will get an email notification as soon as the blog comes out. So starting with Amazon and Microsoft, trillion-dollar stocks, talked about where they're headed. Talked about the dollar. I'll talk more about, share the chart of dollar, where there's some near-term upside, which means that there could be near-term opportunities to get into precious metals because they tend to be negatively correlated to the dollar. So if the dollar is some upside, there's potential that you might get a better entry on gold or silver if that's what you've been eyeing to get in. And then we talk about big in the 5G space, telco 5G space, but now heavily benefiting from their AI chip. Like NVIDIA, of course, is the king of AI, but the king of 5G is Qualcomm, and Qualcomm benefiting from their AI chips in the PCs. There are about, 7 or 8 different Windows-based PC manufacturers that are putting in their Snapdragon chip for powering their AI on these Windows PCs. And Finally, I did put a blog about energy. A big warning came from IEA. It's kind of an energy think tank talking about peak oil demand. They feel that by 2030, there's going to be a glut of supply. The world's going to be swimming in oil. So I just want to look at the XLE chart. Maybe long term, yes, there could be peak oil, but in terms of the chart, see a tremendous opportunity to buy in now when XLE is pulled back quite a bit. XLE is the spider ETF for energy, and then ride maybe a 20 to 25% upside from here. So with that, let me go straight into the economic data. So on Wednesday, we had the CPI data, and there is actually in stockcharts.com a way to plot the CPI data. Just use $CPI. C stands for the core CPI. And we can notice that if you do a rate of change on month over month versus rate of change of 12, which is year over year, month over month, actually, it has come down. It came down to, they announced it as a rounded off figure of 0.2 month over month, but it was actually lower than 0.2. It was at 0.16. If you do a yearly run rate at 0.16, that's closer to 1.92%, which is below the 2% target that Fed has. So if in many ways you could say that, well, inflation is definitely on a steady downtrend. And if you look at the year over year change, that becomes a lot more clear and visible right here. You can see from above 6% from middle of 2022, it has steadily been coming down. There's a steady declining downtrend in consumer inflation, core consumer inflation, core consumer CPI. And it reported a 3.41% for the year over year for the month of May. If you look at producer price index, there again as well, there's been a decline month over month. It does fluctuate depending on how prices change, but it came in at 0.28, so higher than the consumer price inflation. It came at, so the core on the producer came at 0.28 versus 0.6. But look at this steady decline on the producer price index as well from a year over year perspective. Came in at 2.28, closer to the 2% target that Fed wants. Though Fed focuses more on the consumer side of things, but the PPI, a steady downward decline and now plateauing down. Hope is that it doesn't plateau and start going higher, because in the past, we can notice that PPI, which was after right before the COVID, then that's when inflation took off. But before the COVID, it had plateaued closer towards the, less than the 1 to 1.5% number. But it is kind of plateauing down here in the close to 2% level, which is what the Fed wants. So in some ways, PPI tells a pretty strong story. So Fed came out, of course, they had their FOMC meeting on Tuesday and Wednesday. And what they published at the end of the FOMC meeting is that they now expect 1 rate cut this year, when the market started off with 7 rate cuts in January or December late last year to January this year. There was expectations of 7 rate cuts, came down to 3, 2, and now Fed makes it more of a guidance that the expectation is about only 1 rate cut this year. However, they do say that they potentially do see 4 rate cuts next year. So between 5 rate cuts, starting 1 this and 4 next year, talking about a 4%, because we're in the 5.25 to the 5.5 range right now as the Fed's funds target rate, which means it would come to the 4 to 4.25 is where they see it coming down. However, their inflation projection did go up. They've been steadily increasing it. The first few months of inflation, we know, had been strong, and Fed didn't like it, especially the owner's equivalent rent, OER, has been high. Overall housing, or auto insurance prices, there's been some of those sticky and higher prices have caused Fed concerns about inflation. And so they did increase their projection on, this was, of course, Chair Powell did say that this is before the CPI data came out. The FOMC members had already put their expectations for a 2.8% end of the year core inflation target, which went up from the last. They published this quarterly. In the previous quarter, they had published a number closer to 2.6%, but now they've increased it to 2.8%. So this is still a concern for Chair Powell, but he did say that meeting by minute, they will administer the data, let data lead the way, and then make their final decision. If they have to do it abruptly, they will. But right now, they expect cuts to be only one for the rest of this year. So I've always talked about the 10-year yield as a key barometer for the stock market, for where the economy, because it directly also links up to the mortgage rates, how consumers get impacted in taking long-term loans of any kind. And we know that the 10-year yield had an ascending triangle breakout of 4.35% that measured to 4.92%. However, it didn't quite get there. It topped out at 4.73, had pulled back to 4.3 in the mid-May timeframe. From there, went up to 4.63 again. And then in June, it has been trending lower. In many ways, you could say that this is in some form, some technicians will draw what you call as a wedge, a bullish wedge, in the sense that rates could keep climbing again. We know that there is a gap here called a bullish, it's like an island cluster gap. And for that gap to close, 10-year yield has to climb up to 4.78%. Now, I can quickly draw what I mean by the bullish wedge. If you look at these things right here, let me just take the arrow off. And this right here, that's the kind of bullish wedge. And in fact, people may draw it a bit steeper by just changing this to more like that. And bringing it down here. So that's the kind of bullish wedge that many are looking at. And that bullish wedge means that if it holds, so we know that 4.35, 4.3 was one support. It kind of tested, then rebounded, broke that. And now key support is, as you can see, 41.98, 41.83. It's about the 4.18 to 4.2% is where it tested. It tested 4.18 right there and closed above 4.2. 4.21 is where it closed. So you could say that from a bullish wedge, technicians could draw and say, well, we could perhaps have tested this and rebound. And that could mean that the yields could start climbing. Now, reasons of yield starting to climb could be potentially maybe, some hotter data. We know that employment has been weaker. Though employment has been strong in the month from the terms of number of jobs, no question. 272,000 jobs got reported in May. But in terms of unemployment, from 3.9, it has gone to 4%. And also, we know that there's been slowing down overall of economic data. So there's also that bit of a concern. But if interest rates projections go up, that would not be good for the market. So this is something definitely to look into and see what happens. Now, the other thing I'm following, which corroborates with a bullish wedge on the 10-year yield and the yields rebounding back higher, is that the dollar has a beautiful cup and handle. This is the daily chart of dollar, UUP, from 26.92 as the bottom of the cup to 28.26 as the top brim of the cup, the right brim of the cup. So if you measure the difference and add it up to the top of the cup, that takes you to 29.6. And that's perhaps where we could see dollar headed to. And UUP actually fell after CPI because market thought that, well, interest rates are coming down, and that when interest rates come down, especially 10-year yield, it does impact the dollar. So the dollar weakened. But the last couple of days, the dollar rebounded and it tested 29.06 today, pulled back and closed right below 29 at 28.99. But tendency is that this breakout above 29 could get us back to the target near 29.6, and that could corroborate with the 10-year yield from its bullish wedge rebounding. So that's something to look at. Now, we noticed that when the dollar did pull back, the PPO did come back, they have a PPO reset, tested the zero line, and PPO now has crossed over and begun to climb. So technically, there's a good possibility that we could see a dollar rally in the next few weeks. And usually dollar rally is a bit of a safe haven buying, is a bit of interest rate related when 10-year yield goes up, and it could have a correlation with the market coming down. So that's something to look at. Now, talking about market, usually whenever we do our weekly recordings, we talk about the core ETFs, the QQQ, SPY for the Spider, S&P 500, Diamond for DIA. This time we're going to skip it. I've got so much more to talk about in terms of the story stocks, talk about Gamestop, talk about the energy. I decided just to focus on the core hottest in ETF out there, which is QQQ, which is Nasdaq-100. Well, look at the weekly chart. I always like to visit this to get the bigger picture on where we think it's headed. A beautiful cup and handle with 402 is where the left brim of the cup is. The bottom of the cup is 251. The right brim of the cup is 285.93, which is about 386. Take 386, 251, you're talking about 134 points roughly. Add that to 385.93, that takes us to 134 plus 385.93 is 519.93, which is closer to the 520. So that's a target that we think we are headed. We're almost there. We are at 480. 480 to 520 is another almost 40 points of rise, which is less than 10%, right? We are talking about 40 points out of 480, like maybe you're talking about 18%, 8% is all we have to climb to get to 520. Negative divergence is a concern. RSI is weaker, lower high as it's climbing. So that's something so we got to watch at. But that's where we think UQQ is headed. Another thing to think about is what does the semiconductor sector look like? Now, if you don't see the parabola here, this is how a classic, it's a parabolic shape in terms of the climb, right? We can see that the previous parabolic shape was in the dot-com 1990s to 2000s, but that's nothing in the longer term horizon here. Every candle is a quarter, it's a quarterly chart. But look at the parabola from the 20s in 2016 going up to 156, and parabolas tend to have sharp pullback. So that's when we did get the sharp pullback down to test the 20 period moving average almost cut in half from 156 to 82. From 82, we have climbed up to 268. And that's a factor of almost, we're talking about, 3 plus, right? 3 into 82 is, about 246. We went past it to 268. So 3 times, more than 3 times plus it has multiplied. And that kind of a vertical parabolic climb will have a pullback, something for us to look into. And guess what that is? That's the AI euphoria. That's the AI euphoria that caused this. 2021, the first part of it was not the AI euphoria. That's just overall AI being strong, not just AI being strong, semiconductors being strong, having a nice upward cycle coming out of the COVID rebound, and overall semiconductors being hot. But what we see here is really because ChatGPT stuff came out late 2021, 2022 to 2024 is really when the core part of the movement happened. So most of 22 and 23 is where the core monetization of AI started taking off. And we can see that this is hugely powered by NVIDIA, of course. And you got to watch out when you have a parabolic climb like that, that in many ways gives you concern that there might be less, like you saw here, a sharper pullback coming in that sector. Which means if you compare that to the software, in a similar kind of a long-term horizon, it had a parabolic climb as well from 2016 to the 2021 post-COVID huge recovery, then sharp pullback. Like classic end to a parabola is usually a sharp pullback. It pulled back, got cut in half from 89 to 47, and then started its climb, but it's not been able to climb past that 2021 high to the higher high. It is right below that 29.74, 88.82, and is pulled back. It's a possibility that software, we do expect to have a bullish macro trend. There's more and more of cloud software across the enterprises. So this could just be a cup and handle, as in we have a nice cup having formed between 47 and 88. We are now pulling back to form a handle, and we could then have a breakout. And a breakout from there, 47 to 88 is 41 points. Add that to 88 or almost 89 plus 41, that's 130. So it's a possibility that we could be headed to 130 eventually on IGV, which is the ETF for software. But it's not, the climb has not been past the 2021 high, and that's not been like the AI-driven parabolic in the semiconductor industry. And in particular, NVIDIA has been the king of this, driving this sector higher, the biggest component weight-wise in SMH, which is the semiconductor ETF, the VanEck semiconductor ETF, and something for us to be concerned about. Now, I talked about this week, something else very interesting happened. three key trillion-dollar stock literally competed head-on to define their hegemony as the largest market cap stock in the world. And turned out Microsoft won so far. Microsoft was the leading stock till very recently, yet Apple and NVIDIA shot up this week. And now they're all very, very close. They're all within the 3.24 to 3.28 trillion market cap zone. Microsoft had a beautiful breakout above, if you can see from its cup and handle, from near 425. It tested 425 multiple times, and then it broke out. So 404 to 425, that's about 21 points. At 21 to 425, that's 446. Now, that's just a cup and handle, but if you measure it from the 430 level, right, that's where it kind of tested and broke out. Or if you look at the shorter term chart of 436 to 443, and then that breakout, that's roughly 436 to 443 is about 7 points. Add 7 to 443, that's 450. So Microsoft is headed to 450 near term. And this is, by the way, an hourly chart. So just look at the movement from 404 to 450. That's almost a 10% move that happened just over the month of June. So this has been an accelerating month with the AI-driven stocks just absolutely powering higher. Apple was a big story this week, was their Worldwide Developer Conference. Their AI, they call it their Apple Intelligence launch into their OS across their product line. And after the launch on 10th, initially the market kind of had a ho-hum reaction. It kind of took back, but then starting Tuesday, analysts were bullish. Analysts expect big mega cycle of upgrades kicking in, a super cycle of upgrades kicking in on closer to, huge, I think almost 240 million or actually 440 million or so Apple devices that have not been upgraded in a while. So Dan Ives and other analysts are hugely bullish on Apple, and they expect that to break out and continue. And that's what Apple did. On that bullish expectation, though they're not going to monetize this AI right away, but just on the hopes of the bullish expectation, it broke above a key resistance level. It had previously touched 199. It broke above that with heavy volume, broke above 200, and they just ran in a vertical fashion. Just a 10% move from 200 to 220 in a straight vertical fashion in the span of 2 days, Tuesday and Wednesday. Tuesday was from their Worldwide Developer Conference reaction, and Wednesday's climb was further from 207 to 220 based on the CPI data being lukewarm, and then the expectation that Apple will continue to do well. Since then, it has pulled back, but this is something that is quite a climb, a large $3 trillion stock. It had just fallen right below 3 trillion in the last couple of months. But after their Worldwide Developer Conference, WWDC, it has taken off. And now, as I said, between Apple, Microsoft, and NVIDIA, all at the 3.2 to 3.3 trillion space is where they are. NVIDIA, of course, has a steady climb all along from May. This is nothing new. This, of course, huge gap up was, and by the way, this is a stock split. This was not too far back, $1,000 stock, 10:1 stock split. So when you're seeing a 132 handle, 133 is what NVIDIA came to test. That's a $1,330 stock. That 10:1 is 132.84. Steadily climbing. This was the gap up after earnings. Touched 1,063, came back to 1,020, steadily climbing up on the 20 and the 50 period, which is hourly in this case. 60-minute is hourly candle chart. And there is concern from negative divergence. As it climbs, RSI keeps getting weaker. So you can see a much stronger RSI in the first thrust climb from 93 to 115 or 116, which is 1160 pullback. Then the next thrust of climb RSI, when it climbed to 125, RSI was not as strong as the previous one. And in the recent climb, placing to the 130 to 133 level, it is much weaker than in the past. So this is in many ways a negative divergence, something to be concerned about, that near term, you could be looking at the potential NVIDIA top. Now, where do we measure that value for where NVIDIA could be headed? Well, if you take 117 and you take, so this is a bit of a cup and handle, about the 125.58, 126 and the 117, that's closer to 117 to 126 is about 9 points. Add 9 points to 126, that's 135. So that's one area that you could be looking at where NVIDIA could be headed. But if you look at, from kind of a longer term chart, there is what we call as a bullish flag, and the pole of the flag and the movement out of the breakout of the bullish flag is closer towards the 145. So there's a possibility that NVIDIA could go closer to the 145 level. In fact, if I take from the hourly and go out right to the daily, I think this will become a little clearer. So right here, you can see that this is in many ways, right, like from the 75 to the 115 to the 116, pull back to the 106 to the 125. So this from the 106 to the 125 is about 19 points. To add 19 to 125, that's 144, 145. So that's the 1450. And when I'm talking about the bullish flag, this is the 47 to 97. That's a 50-point flag pole. And then we have a flag forming from 97 to 75 over a time period of 2 months. So that breakout of the flag, so that's the 40-point length of the flagpole, added to somewhere near the kind of 95 breakout point right here. So 95 plus that 50 is 145. So that's, again, a target heavily overbought where NVIDIA could be headed to. Now, Oracle was the other AI-driven story stock. I talked about great earnings, adding almost 30 new customers on their AI forum, on their AI-driven cloud, double-digit growth in revenue in the AI. And most importantly, if you look at their breakout, that was a massively beautiful cup and handle here, by the way. 126.7, 114, 126. That's a 12-point depth of the cup. At the 12 point to the 127, that's 139. It did touch 139, pull back, but resumed its climb and has been steadily climbing, touched 142. It has pulled back and closed near the 138, 139 level, but that was a beautiful cup and handle breakout. So that's the cup, 126 to 126.9, the handle, and then a massive volume gap up, kind of a close. So now what ends up happening is 135, which is the top of the gap, becomes strong support. So that's something we're going to look at for Oracle. Broadcom's earnings were also outstanding, almost, with respect to their earnings growth and showing their cash flows and so on. They have been doing brilliantly, and 25% of the revenue they contributed, I think they were close to 14 billion of revenue. 25% of the revenue they contributed were AI-related products. 10:1 stock split, it shot up. Again, a beautiful cup and handle here from 13 to 1450. So that's 150 added to 1450. That's what, 1550, 1600. But it did exceed that by a bigger margin. It hit 1735, pull back 1750. A 10:1 stock split gives it the momentum. Shareholders love it, and they've been chasing the stock higher. Similar kind of breakout with massive volume. Another AI story was Adobe. Adobe, we know, is in the publishing, video kind of creative business, but AI driving their efficiency. They talked about 2 billion cash flow out of their 5.3 billion of revenue for the quarter. Heavily AI-driven efficiency. Shantanu Narayan, their CEO and founder, was in Kramer yesterday, heavily touting about their AI capability. They do believe in AI next to the human, not AI replacing the human. Shantanu kept talking about it yesterday, saying that, look, AI is here for sure, but we do see AI giving in the ideation phase, telling the creators what to create. And then from there, no one matches or beats a human's creativity. So he expects the human to continue to use Adobe's products to do that creativity, but with the assist of the AI, would be able to ideate and create things faster. With that, I'm going to talk about what's been in the story, a big story stock, GameStop. We know it's got meme status, but at the end, they're in the video game retail stores around the world where they sell video games. And it's been a huge climb back in the 2020, 2021 because of meme followers in Reddit. And the key guy, Keith, has been driving this higher with Keith Gill is his name, in his Reddit, in his YouTube, and in his Twitter or X platform. From 78 cents, it went to 128.75. That's a $120 wave one move. Then the wave two came in, pull back to test right near core resistance near the 9 and 10 bucks is where it came down exactly and stopped right there. So that's wave two. Wave one, 78 cents to 120.75, $120 wave one climb. Wave two from 120 came back to 10, so it's a $110 wave two drop. And now it's just broken out. You can see this beautiful bullish flag. Similar idea for bullish flag. However, wave one, if you add 1.618, which is what Elliott wave computes as a wave three length from a wave one on a true bullish move, a 1.618 on a 120 added to where it broke out from, that's the low of wave two around 10 bucks, measures to 204. So technically, can't rule that out. This wave three on GameStop could head towards 204. It has so far been solidly bullish, broke out to 64, pulled back at a higher low. It's been basing here. And if we look at a near-term hourly chart, you can see the beautiful cup here from 45.17 back to 48. That's a nice cup. Kind of saucer-shaped cup here, like beautiful kind of base forming in that cup. Then the second, it's more of a saucer-shaped second cup happening than really so much of a handle. But the 48 pulling back to 22, up to 33, and so on. If it pulls back to 48, and then from there breaks out, the measured target is from 17 to 48. That's 17.7, rounded up to 18 to 48. That's 30 points. Added to 48, that's 78, which it had touched, by the way. When intraday, it had hit 63 on the early part of May when Keith Gill was out there. It had touched 78.80 actually at that pre-market. So it's a possible that it could go back towards the 78.80 on this cup and handle. So that's what we're watching. This pullback has been on declining volume so far. When it does go higher, the higher climbs are always on strong volume. Here is another climb on strong volume. Lower declining volume pullback. Keith Gill has transferred his options. He had 120,000 call options and 5 million of stock. He converted this 120,000, he sold them and bought additional shares of GameStop. Now I think he has close to 9 million of GameStop shares, which makes him the top 3 or 4 shareholder of GameStop. They do have a Monday investor call. They were supposed to do it this Thursday. They had technical difficulties. So Monday they'll have that investor call. It'll be very interesting to see what happens to GameStop after that. But near term, as I said, if this is a beautiful saucer-shaped cup, another handle forming, but another kind of a saucer, smaller cup, that breakout from 17 to 48 is a 78, 79 level that we're looking at. Now I'm going to end today with discussing energy because that's been actually performing quite poorly. We did publish a blog back in early April talking about energy being ready for a pullback, and that's exactly how it panned out. Panned out in terms of a descending triangle pattern, 98 to 493. If you subtract that and measure the target, 88, 87.95. It came exactly there, 87.67. And now I'm expecting this to start rebounding. So that's something to look at. Now, where am I expecting it to head? Let's look at the weekly chart of XLE. Again, a beautiful shaped cup from 89, a saucer-shaped cup from 89 to 72, back to 91. So that's a 20-point climb. If I just add that 20 point to the 91, that's closer to 111. Now that's a target. However, the second cup that formed, another saucer shape, and call it the smaller cup. So it's almost like the first is the bigger cup, the next one is kind of a handle, but a saucer shaped handle. That measure is from 78 to 98, another 20-point climb. You got a pullback from there towards the 88, which is where the 87, 88 is the 50-week moving average, core support, which is tested successfully. I expect it to hold. And then a climbing, a RSI, beautiful pullback on this couple of months of pullback from 70 plus to 50, 46 to 40, 50. That's a beautiful neutral zone when bullish charts tend to base out and then start climbing. So now is the beautiful, perfect time on the successful test of the 50-week moving average climbing along with the 20, and that breakout measures to 120. So 120 from 88, you're talking about roughly 30 points, right? Almost $30 move from here, and $30 in 90 is 33%. So that's an awesome move right there. We can see that the AD started climbing when it was initially climbing from the 40 to the 86, like 2021, 2022. Since then, it has been holding steady. It has not come down, which means smart money is holding on. This is in spite of bearish reports from IEA, not just once. In March, they talked about peak oil. Here again, in June, they published a peak oil report. They expect demand to peak out. Why? They're talking about electric cars coming in. That's be hugely, bearish for oil because there's be less dependency on oil. They're talking about efficiency in the electrical generation, less use of oil and more natural gas, liquefied natural gas, more use of nuclear and other energy, solar, the modern kind of alternative energies to generate electricity. And hence their expectation that oil is going to peak and oil prices we'll be swimming in oil, will be glut of oil, and hence oil prices will come down, which means that could be the possibility long term. But in the next few weeks to months, I think we are in a perfectly great position, absolutely wonderful position to buy XLE, and this would be one of the great calls we should look into. With that, thank you for listening in. To sum it up, we feel that the AI-driven frenzy has been absolutely crazy. We do think that QQQ is headed towards the 520 target, not too far from here, maybe 8% more upside. But beyond that, this negative divergence, looking at this very parabolic semiconductor AI-driven climb, I'm going to get a lot more cautious. I would suggest to lighten up your portfolio. Past the 520, I would in fact even go to 100% cash if I have to, and especially get out of the tech-driven frenzies, because those will be pulling back sharply. If you do want to invest out of tech like AI into some other sector, try to drive the software-driven play of AI, because remember, hardware comes first, software comes next. The hardware layout has happened, the clouds have thrown in the GPUs, but now the efficiencies of that AI will be what we will be looking at over the next several years. And the efficiencies will come through software. So the software, more and more of the software vendors will implement AI into their stack. Those efficiencies will drive this. So I think what we just got, a Salesforce pullback, was a perfectly great opportunity to buy Salesforce. Those are the companies that were eventually, same thing with Snowflake. It's pulled back to 130 level, a great place to go buy Salesforce. So this cup is formed from 89 to 47 back to 89, pulling back from the handle. I expect that breakout to come in. I expect maybe a 70 or 75 level for IGV for us to be able to pick it up. And then from there, it should be a beautiful cup and handle breakout. So that's the sector I would focus in on the next market correction. With that, thanks again for listening and good luck for trading next week.